real estate slowing, consumers losing confidence, and inflation up. But labor market staying strong, GDP is up, and we are seeing lower interest rates. My name is Jay Rios, and welcome to another weekly recap. Today, we're talking about August 25th to August 29th in the U.S. economy. Let's start at the beginning of the week, where the Realtor Association released new home sales data, which was seasonally adjusted to 625,000. Month over month, this is a decrease of 0.6%, but even worse than that, this time last year, we had 8.2% more new home sales. With 625 listings, it would take buyers about 9.2 months to completely clear any inventory, and that's without any new listings coming to market. With this new report, we saw the median home sale price drop to about $487,000 from $505,000 the month before. It's clear the prices are going to continue to decrease as they have been since about spring of this year, and as we head into the winter season and more of a buyer's market. When it comes to new home sales, builders and developers are trying to entice buyers with more incentives and price drops, but it just still does not seem to be working. For the first time in a while, existing home sales are actually cheaper than new home sales. And this is concerning because, of course, that's going to de-incentivize developers to continue building when we have such a limited inventory as it is. We simply don't have enough homes in the US to provide for the growing population. In summary, new home sales drop and will probably continue to throughout the rest of this year. Tuesday, we got consumer confidence from the Conference Board. And as I said at the top, this is decreasing. It fell by 1.3 points for the month of August. This is now 97.4 based on a 100 metric set in 1985 and coming from 98.7 in July. Remember that consumer confidence does have a couple subsectors, those being the present situations index and the expectations index. The present situations index dropped by 1.6 points and the expectations index dropped by 1.2 points, obviously indicating that people are concerned about the now and what is to come. Now, what's interesting about this is that the month before, consumers were actually confident in the expectations index. They were looking forward to what was to come in the near future. Not the case anymore. Consumers also expressed concern with the new tariff policies, citing that their expectations of inflation over the next 12 months are now rising, particularly with food and groceries. This report does differentiate between our two main political parties here, Republicans and Democrats, and both parties were equally as concerned, specifically with the labor market. In summary, people are worried, specifically about the labor market and inflation. Now, on Tuesday, we got the Case-Shiller home price index. And yes, this did rise, but by a slower pace, 1.9% year over year, and marking the slowest home price growth since the summer of 2023. This is down from 2.3% the month before. It's possible that the interest rate lock-in effect is taking place here, with sellers reluctant to let go of their 3% mortgage rate for 6.62% being the average of the 30-year conventional mortgage as of today. Of course, the closer we can get to 6%, the more likely sellers are to sell and move on to a new house. And mortgage rates have been decreasing since about the middle of last month. In summary, home prices are decelerating, and hopefully lower mortgage rates can combat that. Now, that's the first half of the week out of the way, and let's finally get to some good news with Thursday's initial jobless claims report. Initial jobless claims fell to 229,000 this week, which means that 5,000 fewer people filed for unemployment. This is a huge relief considering that the month before, 10,000 additional people filed for unemployment. Economists were really concerned that this was going to be more of an ongoing trend and ultimately the potential downfall of the labor market. Even better than initial jobless claims was continuous jobless claims, which fell by 7,000 after trending higher throughout this year. I'm seeing a lot of people use the term no hire, no fire. It just feels like it's in a very stagnant state right now, maybe waiting for trade policy effects or just what the economy has in store. When we're talking about the labor market, remember that the labor pool is decreasing given the recent immigration policies. Fewer people are coming to the United States. Fewer people will automatically lead to fewer unemployment. So just keep that in mind as it's somewhat of a caveat here. In summary, the labor market is holding up and showing some promising signs. Thursday, we also got pending home sales data. Of course, anything real estate related is going to be local, but nationally, this did decrease by 0.4% month over month. However, we're 0.7% better than we were this time last year. Remember that this slowdown comes despite lower interest rates, higher inventory, and more price cuts. Buyers are likely hesitant, just like we all are, about the economic future, and again, with these rising home prices. The good news here is that realtors are still confident about the future, with 16% of them expecting more buyer traffic and 21% expecting more seller traffic. And I agree, we're also seeing a lot more activity here, especially especially on the selling side. In summary, fewer homes under contract, but realtors still think that there's going to be some movement. Last but not least, Friday, August 29th, we got the PCE index, Personal Consumption Expenditures Index, which again is the Fed's preferred gauge of inflation. Unfortunately, yes, unfortunately, core PCE, which does not consider food and energy that can be sometimes volatile, did increase to 2.9% annually, and this is up from 2.8% annually the month before. Month over month, though, it only increased by 0.3%. Non-core PCE, which includes food and energy, remained at 2.6% annually with a 0.2% increase month over month. Remember that the Fed wants this to be at 2%, and in fact, it's going in the opposite direction. However, people are still confident that the Fed will drop the interest rate when they meet next month, September 17th. And in fact, some people are saying that there will be a 50 basis point total decrease by the end of this month. They have 3 more meetings. Our prediction is that they'll meet in September, drop it, October, keep it, December, drop it again. In summary, inflation's still pesky, but the Fed have a lot of other variables to consider when they meet and decide on their prime rate. Thank you all so much for watching. We put a lot of time and effort into these, so I hope you learned something. Like, subscribe, comment if you have any questions, and I look forward to seeing you in the next one.